Okay, let's look at an example where we're making a purchase with where we get like a deal and we're paying one price for more than one asset. If you remember from your reading and the slides and the video that I posted, this is what we call lump sum asset purchase or a bargain purchase when we purchase more than one asset at a discounted price. Okay, so here in this example, we're looking at short exercise 10-2. And we have Rural Tech Support, and they paid $130,000 for a group purchase of land, building, and equipment. And at the time of the acquisition, the land had a market value of $70,000, the building $56,000, and equipment $14,000. So we need this information to kind of allocate the purchase price because we only bought this group of assets for $130,000. So what we do is we list all of the assets. So we had land, building, and equipment. So we have 3 assets here. We're going to come over here and we're going to take the fair market value and we're going to see what percentage each of these assets is of the total value together. So we're going to list in all of our values. So the land was $70,000. All right. Let's switch that to a number. The building was $56,000 and equipment $14,000. So all together, the total value of our assets was $140,000. And we bought this for $130,000. All right. So what we're going to do is we're going to take this and we're going to see what percentage each is of the total. So we're going to take that $70,000 divided by $140,000. So the land is 50% of the total value. Okay, so it's 50%. And we'll do the same thing for the building and equipment. So we'll take 56,000 divided by 140, 14,000 divided by 140. So we got 50, 40, and 10%. Then we'll take whatever our purchase price was, and for this example it was $130,000, and multiply it by the percentage that each asset makes up of the total value. Okay, that's the only way we can allocate the cost among our assets. Okay, so $65,000 goes to the land, $52,000 to the building, and $13,000 to the equipment. All right, so when we record the journal entry, we're just going to debit each asset for the amount that we calculated we're going to allocate. So the land, it would be $65,000, building $52,000, and the equipment $13,000. And we would credit cash, since it says we paid cash, I believe. Yeah. Oh no, they signed a note payable. So then this would be for a note payable. Okay. So that's how we would calculate and allocate our purchase price between different assets that we buy in a group. All right. Now let's